All right, in this video, we're going to do some comparisons between Home Depot and Lowe's, and we're going to be using the Home Depot and Lowe's balance sheets over the last 5 years. Again, these are not the same, exact same as the companies filed. I took the filings that Home Depot and Lowe's made, and then in a few areas, I tweaked it to force it into the common template. Some companies report more detail, some companies report less detail. Somewhere in the 10K, the Lowe's 10K was 128 pages, and the balance sheet is only one of those pages. But they'll have 40 or 50 pages explaining what goes into each of these accounts. All right. For instance, they might describe things like cash as cash and near cash or short-term investments. Typically, cash includes anything really, really liquid that turn into cash within the next 90 days, like a bank CD, okay? But they'll actually explain that if you get into the annual statement, okay? So cash equivalents. This is from Home Depot. We consider all highly liquid investments purchased with original maturities of 3 months or less. That means when we bought it would mature or pay us back within 90 days. To be cash equivalents. Our cash equivalents are carried at fair market value and primarily consist of money market funds. Okay, so now we know. Let's look at Home Depot's receivables. All right, the accounts receivable or receivables in here. They have some card receivables, and that's from a Home Depot card, typically to contractors. That ain't when you go in and use your MasterCard, though. Rebate receivables, customer receivables, other receivables. Card receivables consist of payments due from financial institutions for settlement of credit card and debit card transactions. Rebate receivables represent amounts due from vendors for volume and co-op advertising rebates. Customer receivables relate to credit extended directly to certain customers. That's contractors, and that's where they actually lend the money. When we start looking at the card receivables, it's not much in there, and bottom line, it's just a weekend float in between when the accountants show up to count up the money from day to day. Remember, Home Depot had $120 billion in sales, and there's less than $1 billion in these card receivables. So if you counted that as the number of days worth of sales, the answer is not many. All right, so they got an explanation of what they have in receivables, in cash. They talk about their merchandise inventory. The substantial majority of our merchandise inventory are stated at the lower of cost. And when they say cost, they mean first in, first out, or FIFO. Notice they're not using the acronym, but they expect everybody who reads through this is written for laymen, not accountants. You expect everybody to know what FIFO is. That's because everybody who has any business trying to read a financial statement has had this basic accounting class you're into. Okay, and also based on number of factors such as markups and markdowns and inventory loss or inventory shrinkage. So when inventory shrinks, that gets taken out of there. They also go in and describe some of the other stuff that they do to adjust to make the valuations come out a little bit more stable. All right, so we can see that where Home Depot is reporting net receivables of $2,106,000. You can see they're actually explaining where the numbers came from, buried inside their financial statement. Only has 86 pages to it, their 10K filing. The inventory assets at $14,531,000. Well, let's move on to some of the other assets. So we can see, interesting over here is that Lowe's doesn't have any net receivables. Oh my God, why does Lowe's not report any net receivables? Well, there's a reason for that. And what we can do is go over and look into the Lowe's 10K, go to the notes to the financial statements, which are right after they do all this stuff. They start telling you what everything is. Cash and cash equivalent. Cash equivalents include cash on hand, demand deposits, checking account money, and short-term investments with original maturities of 3 months or less when purchased. Okay, so virtually they word it a little different than Home Depot, but they're telling you what's in there, and it's the same stuff that's in your accounting textbook. All right. They have a separate account for investments, and those are short-term things that are more than 90 days, but we're not going to screw with that. Merchandise inventory. The majority of the company's inventory is stated at the lower of cost and net realizable value using the first in, first out method of inventory accounting. All right, that's how they get the cost of the inventory. They use FIFO just like Home Depot, but if they have inventory out there that it goes bad or shrinks or they can't sell it, then they write down the inventory, not to the historical cost, but what they could sell it for. If we move on to they're not reporting on their accounts receivable, so I have to search for it. Let's look for receivables. All right, there we go, right under derivative financial instruments. The reason, come on, I swear I hate mice, but I love them a whole lot more than I like these trackballs. All right. Sale of business accounts receivable and credit program. The company has branded and private labeled proprietary credit cards, that's the Lowe's card, which generates sales that are not reflected in receivables. Under an agreement with Synchrony Bank, credit is extended directly to customers by Synchrony. So it says Lowe's on the card, but Lowe's isn't lending you the money. Synchrony Bank is lending you the money, and they're paying a fee to Lowe's. So essentially, Lowe's gets the benefit of a Lowe's credit card, making it easier for you to shop, but they don't have to worry about you sticking them with a bad bill and stuff. Okay, and then the company also has an agreement under which Synchrony purchases at face value commercial business accounts receivable originated by the company on these accounts. That's why the receivables are zero. It isn't that they don't do receivables, it's that they sell the receivables to somebody else and they convert that money into cash immediately. Okay. Inventory assets, like we saw in the other thing. Notice that the inventory is roughly the same, a little bit lower over at Lowe's, but remember, they had $70 billion in sales. They had $110 billion in sales. Lowe's is generating 60% more sales with roughly 10% more inventory. So we have ratios, the inventory turnover ratios and things like that to show you why that's such a good thing. But it just goes to show that Home Depot is able to churn the inventory so much faster, and it makes them just that much more efficient than our good friends over at Lowe's. And I buy a lot of stuff at Lowe's, but oh well. We'll briefly look at the other fixed assets, all right, the depreciable assets. Now, that's one of the things I want to make sure you understand. Current assets are not depreciated, they're expensed. When you sell inventory, you expense it as cost of goods sold, okay? Fixed assets are depreciated. So these are the net fixed assets, net of depreciation. That's long-term assets. And the companies will explain the property is recorded at cost. Costs associated with major additions are capitalized and depreciated. Capital assets are expected to yield future benefits and have original useful lives which exceed 1 year. They're long-term assets that are going to help generate sales in multiple periods. That's why we depreciate stuff over longer periods of time. Most of the time, they will give you a table of stuff. I think Home Depot actually does. They give you some idea of how long they depreciate stuff, 5 to 45 years for buildings, 2 to 20 years for furniture, 5 to 45 years for leasehold improvements. So this is the net fixed assets after depreciation. We had a video in week 3 of the COVID virus, which actually broke those numbers out in more detail for you. Operating leases. All right, operating leases are now being recorded as assets. This is the operating lease, the right to use the assets. And there's also a corresponding liability down there for the obligation to pay the operating expenses. Other non-current assets include some of the stuff discussed in Chapter 8, and we'll talk a little bit about that in another video. So Lowe's had $110 billion in revenue, okay? If we go and look at what the sales were, and they did those sales with 50 billion assets. So they get about $2 of sales, $2 and change of sales for every dollar of assets. And our good friends over at Lowe's don't do that. If we look sales per dollar of assets, it's about a stupid mouse. So Lowe's generates a whole lot more dollars of sales with the same level of assets that Lowe's would have. So Home Depot can make more sales with the assets they have than Lowe's can. It makes them more efficient. And that's why we pay attention to stuff like the turnover ratios so that we can get an idea of who is more efficient at generating more income.